Imagine a company that is literally taking pictures of the entire Earth from space every single day, tracking farms, cities, oceans, and even military activity in real time. Now, the real question is simple. Can something like this actually make investors rich in the long term, or is it just another futuristic idea that looks exciting on paper but struggles in reality? Today, we are talking about Planet Labs, PBC, a stock that has divided Wall Street into two extreme opinions. Some people believe it is the future of Earth data, others believe it is a crash burning experiment. So let's break it down properly. Should you buy it, hold it, or avoid it completely? And most importantly, what is smart money actually doing right now? Planet Labs PBC is a satellite imagining company. It operates a large fleet of small satellites that continuously capture images of the Earth. These images are then sold as data to government defense organizations, agriculture companies, and climate monitoring agencies. In simple words, their goal is to become the live data layer of the planet. This sounds extremely powerful because almost every industry today depends on real world data. But here is the problem. Powerful ideas don't always mean profitable businesses. Even though Planet Labs is growing its customer base and expanding its data services, it is still struggling to become consistency. Profitable revenue is coming in, but expenses are very high because building, launching, and maintaining satellite costs a lot of money now. Let's look at the stock side of the story. Since going public, Planet Labs stock has been extremely volatile. At one point, there was huge excitement around the company because investors believed space data would become a trillion-dollar industry. But after the hype cooled down, the stock started falling sharply and entered a long correction phase. Today, the stock is trading roughly in the low single digit range, usually fluctuating between around $2 to $5 depending on the market conditions. This tells us one clear thing: the market is still not confident about its profitability timelines. And this is where the real debate starts. Is this a future winner or just a long term trap? Now, let's talk about smart money and what industrial investors are actually doing. The reality is, smart money is completely divided. On one side, bullish investors believe Planet Labs is sitting on a massive future opportunity. They argue that space-based data combined with artificial intelligence could completely change industries like agriculture, defense, logistics, and climate forecasting. They see this is a long-term infrastructure play, something similar to owning the early internet backbone. But on other side, cautious investors are not convinced yet. Their main concern is simple. The company is still not profitable and cash burn remains high. Every year, a large proportion of revenue is going back into operations and satellite expansion. So, smart money behavior is mixed. Some hedge funds are holding small positions for long-term potential. Others are waiting for clear profitability before committing seriously. Now, let's talk about the future catalysts that could change everything. First, artificial intelligence. If Planet Labs successfully integrates AI with satellite imagery, the value of its data could increase massively. Instead of just images, it becomes predictive intelligence. Second, government and defense demand. Many countries are increasing spending on surveillance and other monitoring. This creates a stable long-term customer base. Third, climate and environmental monitoring. As climate risk increase globally, demand for real-time Earth observation data is expected to grow significantly if all these trends align and execution is strong. Planet Labs could transform a loss-making company into a major global data player. But we also need to talk about risk. The biggest risk is continued losses. The company is still not consistently profitable. Second, competition is increasingly in the satellite and the space data industry. Third, high operational costs remain a serious challenge. And fourth, investors' confidence is still not stable. So, what does this mean for investors? If you are thinking short term, this stock is extremely risky and unpredictable. If you are thinking medium term, it is still certain because the company has not proved stable profits. But if you are thinking long term, this becomes speculative growth bet. If execution improves, this stock could deliver strong upside in the future. But if execution fails, downside risk remain significant. Now, the final conclusion. Right now, smart money is not aggressively buying or fully exciting. It is mostly in a wait and watch or small positioning holding mode. So the honest classification would be this. It is not a clear buy, not a clear avoid, but a high risk long term hold for patient investors. And one important lesson here is simple. In stocks like this, the difference between success and failure is not just the idea, it is execution over time. If you want more deep stock breakdowns like this, make sure to follow for the next analysis. Subscribe the channel, like the video, and share your comments with us, and we will get back to you.